Hello, accounts people. Let's spend a few minutes, probably about 20-25, so pause and watch bits differently, on international accounting standards and international financial reporting standards. Right, it's just an introduction. It's just a general theory and explanation of the purpose. Detailed questions, all the available publishers. The list, for instance, for AA2 Level 4 takes me a day and a half on a day group or similar on an evening group to go through with appropriate questions. They're big and there's lots of text, so minimal what we can do in about 20 minutes. Let's have a look then. So, generally, the guidelines that accountants use, in addition, of course, to the conceptual framework, primarily concerned with the completion of financial statements, making sure we put the right numbers in there. They're internationally agreed, accepted, at least 144 countries, I think it is now, China coming into line as well. It means that accounts produced in one country, America or South Africa or Nigeria, they're pretty much the same as any other country. They're allowed to be in the national language, of course. Multinational companies, it means one set of accounts will often do, depending on where they trade. They may need to produce slightly different versions elsewhere. It is a process of agreement and consultation. So it's the world's accountants have got together and agreed on this, not imposition by a government or the UN or anybody else. They couldn't write it because they couldn't tell accountants what to do. Remember, accountants are generally above average intelligence, but they all are actually. And also independent and no question and challenge. That's part of the professional skills of an accountant. So you're not going to impose something on a group of people like that. In the UK, it applies to incorporated businesses only. Sole traders, partners, yes, we do accounts properly. We still follow guidelines. We still have systems that UKGAAP. Mentioned again later. So IAS, tiny bit of history, set from 73 to 2001. It was the IASC. I don't think that ever comes up in an exam question. Replaced now by IASB, the IFRS standards. They're modern replacements and they basically superseded lots of the IASs. So some of the IASs have disappeared. 39 has become IFRS 9. IAS 1 is actually now IFRS 18, although lots of syllabuses haven't kept up with that. I'll mention that again. And also they replaced several IASs, although there's still plenty of them. They're still being replaced and there are updates happening all the time, slight adjustments to them in terms of the interpretation. So if you were looking at something like the IFRS's website today, you would find out that if you thought you knew everything, there's a podcast on IFRS 18, the replacement for IAS 1, that did actually come into operation last year. Even yesterday, something to do with China and an update on the 16th. New trustees, again 2 days ago. It's actually the 18th of December. That's why you're not up to date anymore unless you watched this morning. So, generally speaking, these are the more examinable, most important ones. Doesn't mean to say others don't apply to particular types of business. If you're a group of companies, there are IFRSs to do with that. And depending on your course and level, you'll just study some of them. There's a list coming over for the best of my knowledge for some of the lower level courses. And it's either an outline or in-depth knowledge. In other words, you're going to be asked calculations and do some recommendations. What would definitely have happened on most courses, you will have been taught something that relates and comes from an international accounting standard or an IFRS without being told we're following them. So we can teach you what counts as the cost of an asset, a non-current asset, in terms of the delivery charges, the setup charges, the initial testing, everything ready for first use as a guideline, without actually telling you the detail from IAS 16. and the fact that the policy is recorded in IAS 8. So, quick list, I'll leave that just up, I don't really need to talk through these numbers. You should know roughly what's on your T-level accounts, but Pearson did make a mistake. It is in their errors page. What they called IAS 3 is actually IAS 8 accounting policies. And the list of AAT, notice 80 is missing from AAT, we'll explain that one later. And at level 4 you start to learn a bit more IFRSs, including the dreaded 16. Replacement of IAS 17 leases. They're all possible to Google in depth. I'm just introducing and trying to explain the general theory based on my 20 or so years of explaining them to students. So if you look at a complete set of accounts from a large company, you'll see lots of others mentioned, just to give you a flavour, and that the directors and auditors sign off that we comply with them. Let's get a page of some of these accounts. There's the signatures at the bottom. Director, one of the directors signing every page of the financial statements, and every page also signed by the auditor, because it's a big company. This is Tesco, so yes, it's big enough to need auditing. If we move on, one of several pages I know I can go to. Okay, this one is about provisions. Somewhere on here, further down, there's one not regularly examined or tested, IFRS 9. This is about financial investments and liabilities, because it's talking about Tesco Bank to start off with the other provisions, money that owe customer or credit losses or anything of that nature. And that replaced IAS 39 a few years ago. So lots of others that are around. If you're on level 3 or level 4 courses, you still only are dipping your toe in the water. Back to our slideshow. We're up to 5, and now I'm going to actually start discussing them. So, IAS 1, this is the layout of the financial statements and what should be included. This is where the names come from and the terminology used. However, it has been replaced by IFRS 18. Still talks about the face of the accounts. Was applicable from April last year. But the exam boards haven't adopted that yet, so I know AAT have got a new syllabus soon. Of course, it will mention IFRS 18, not IAS 1. Can't rewrite syllabus every year. Sometimes little updates come through from the examining boards. So IAS 2, sticking to numerical order. Again, one that you may have learnt a lot about without realising where the rules came from. It's about the valuation of inventories in the accounts. What can be included in the value, in other words, some stock, finished goods or otherwise, is sat on a shelf, how you can cost it up, and the allowable method. So this is the one that tells us FIFO and AVCO are acceptable. LIFO isn't. If prices were going down, we'd value inventory at more than we actually paid for it. That's why it's not allowed. There is also a rarely used one called TWAP, an average cost over a time period. Again, like AVCO, it's for where things, liquids or gravel or cement or something is mixed up and you can't determine exactly what batch it was, and if it's appropriate. What matters is not overvaluing inventory. We need to be consistent, stick to the same method, stick to the same way. Closing inventory this year, yes, it's important. It does affect the cost of goods sold and it sits there in our statement of financial position, ACCO balance sheet, but it's been transferred into next year. So if we deliberately underestimated or overestimated for tax reasons, which of course is completely unethical, it will just simply go into next year and the long-term one, unless you were really seriously into unethical behaviour, in which case one day you'll probably in prison. So LIFO, although we can't use it in our financial statements, it's still valid. You would use LIFO a lot if you're costing up for production. You want to know the cost of replacement materials if you're using some of your own stock, essentially, and use the latest prices when you're quoting to customers. So IAS 7, a little bit misunderstood because we have IAS 1 and IFRS 18 telling us about the financial statements, one of which is the statement of cash flows. Um, Explains what's included and the definition, so it's got its own international accounting standards separately. The lower half bit is the IAS 7. It does apply to limited companies, possible to produce one for a sole trader if it's useful information, trying to explain, particularly if somebody's on cash issues and where the money's going out and where the money's going in. It does explain some things sometimes. Now, IAS 8, I know it's not taught at AAT. It's adoption and stating of accounting policies, but you will see in FAPR little boxes telling you the depreciation method, whether it's monthly, full year, in the year of acquisition, none in the year of disposal, etc. at level 3, and you'll see that in other exams as well. Inventory valuation methods that you use, and then also estimates, and actually I haven't put on here also how to correct for errors made in the previous years. So generally speaking, adjustments are made in the next set of accounts. Of course, if it's found out before the accounts are accepted, IAS 10, the next one applies. We can correct it and update it. But then the running totals are long term for our tax liabilities and our assets are then corrected. This standard is constantly updated because it works with a number of others. So if you looked at a lot of the adjustments, there's constant changes to it, which is why it's hard to examine. And look at the reference to inventory, non-current assets, of course, tax later, in particular. So one of the ones I like starting off with for level 4 students, simply it's a good way of thinking about accounts. So we close our books on a particular day. Something happens after that day that materially affects the value. So we put the value in at the best of knowledge and time. It was correct, but something has happened before they've been signed off and presented to our shareholders. So it works with IAS 8. IAS 37 is if we knew about something, we just didn't know how to treat it. Similar ideas, though, similar issues. So its material hasn't been approved. Yes, we are allowed to change and update them. So the best example, okay, we're in December the 31st, we draw up our accounts, and then somebody's had a bad Christmas, and they go back to work, and suddenly their business is closed on the 7th of January. Well, realistically, that receivable in our accounts wasn't going to be received. We may not have had the information to treat it as a specific provision. So if we included it, it would overstate the current assets. It's not going to happen. Just because we only know about it a couple of weeks after doesn't mean to say it was never going to happen. Why? Well, organisations don't just go into liquidation instantly. That company was struggling for a year or two. The one or two cases a year, notable cases occasionally, where a company has literally gone into liquidation at short notice. It wasn't one day and it was the following day. Legal cases, or somebody else going into liquidation owing them lots of money. It was reasonable. It should have been written off before. We were never, ever, ever, ever going to get that money. We will, of course, have to have some evidence of this notification from administrator or liquidation. But other assets may be impaired. It might be technical or other change. It's outdated. There's something wrong with it. Return, sort of knowledge notice not to use and to take it back your motor van to a dealer for something or whatever, and then the value is lowered. Even the tax change on electric vehicles in the last budget affected the assets, the value of electric vehicles. It's made them less viable, so realistically the value's gone down. So some items just require a note. We just have to tell our shareholders, or can be ignored. It's always a risk. However, if it's an asset, it's less of a problem. If it's a liability, it's more of a problem. So you wouldn't want to stand up at an AGM delivering and explaining the financial statements knowing that a factory's burnt down or what you can do, stand there with the fingers crossed behind your back. Somebody might spot that. Or that millions of pounds of receivables will never be received. Your shareholders will never trust you again if you fail to tell them about something that was really, really important and they find out later. They may have very good memories. So the one it's similar to as a pair, this is again, it's the values at the date of the accounts. It's the ones that we knew something was about, but we couldn't necessarily put a number on. So again, IAS 8 matters because it's an estimate. Again, our receivables, an asset value. We don't want it to be misleading, but liabilities as well. In fact, we treat liabilities more seriously than we do assets. We don't count our chickens until they hatch. So generally speaking, if it's an asset, we're less bothered about putting into our accounts because a bonus coming in is not going to get the directors in trouble with the shareholders, but a legal case that started and they were responsible for will. An insurance claim. Okay, this is a contingent asset. It's almost certain to come in. We've sent it. We know we're going to get some money. It's an estimate. And we can deal with it as per IAS 8. We can make the correction in our next accounts if we've over or underestimated. So again, it does say certain items are here. We're less bothered about putting contingent assets in. It's a level down in terms of reporting. But legal cases against the company, these are going to be more important. Probable, we make a provision. Likely, maybe a note. If it's remote, we might rarely ignore it. But legal cases have a habit of coming back and not going away. You may think you got away with not paying somebody some wages, but it will happen. There's a 5-year period for claiming wages in small claims. So, like international accounting standards 10, you wouldn't want to stand up and not tell the shareholders. It will come back. It will hit you. Karma will get you. So this is the one that's possibly easier to teach. Can often be taught without explaining the fact that it isn't international accounting standards, therefore it doesn't turn students off instantly so much. It's the rules about the cost, basically capitalisation of a non-current asset, in other words the cost of getting it up and ready for first use, and the acceptable depreciation methods. Works with IAS 8, mentioned earlier, it's in the policies usually, or it should be in the policies. We've seen it in lots of exams. Guidance on when to recognise it. An asset isn't an asset unless it's actually going to be used and generate some money. If it's sitting in a shed, never to be used again, it's not an asset, even though if it's cost you money and you haven't fully depreciated it. In which case, you would impair it. Next international accounting standard coming up, got its a separate one. Property often goes up in value, so we need to revalue after a time. And then also how we report the losses on disposal. You will possibly do the calculations. Something in our books for £10,000 was sold for £8,000. It's a £2,000 loss. Where do we report it? That loss didn't really happen when we disposed of it. That loss has really belongs to the last 3 or 4 years when we've owned it under the accruals concept, but we can only report it once we know the numbers. Anything else to do with the value in our accounts basic of non-current assets, that is. 36 is the one purely for impairment of assets, again very descriptive, when it's no longer worth the carrying amount, or previously known as net present value, and still net present value in some exam boards, so the old terminology that should have disappeared off the face of the earth really, but accountants take time. If you were trained in the 1960s, you're probably still using a lot of the original terminology. So it works with IAS 8 because again this is going to be mentioned in the policy or estimates, how to deal with an asset when it's lost value other than depreciation. Depreciation is normal trading expense, so it doesn't need an international accounting standards. That is IAS 16. It could be technological. If you're a phone shop, next time Apple produce a new iPhone, your stock of your existing items is suddenly halved in value. It may be damage. You may not even know the damage has happened until you go to the back of a cupboard and find out that some rats have nibbled some cables. I am Birmingham, plenty of rats around. Or there's a leak and something's damaged and you can't sell it, or you've got to download it. Who knows? Might just be a shorter lifespan. Something you thought was going to last 5 years, it's really knackered. Maybe you've just had lots of use out of it and it's only going to last 4 years. Also applies to goodwill, not the goodwill you'll see in partnership accounts, but the goodwill when you buy it, or usually when you buy another company, and the difference between what you pay and what you get. And that can be written down over several years. Descriptive bits, indicators of impairment, why something is not worth the value. And there's also a list of assets, a very boring list if you teach it in class, that have to be reviewed every year. And the general provision, if you impair an asset, you have to double check the value of an asset. Well, yes, when you're preparing a set of financial accounts for a client or for somebody, you should be going around checking that they do exist and it looks realistic, a proper visit. Quite often, Dan, I find my apprentice, or level 4 apprentices, they don't necessarily realise, but kind of when they're wandering around companies, they're being told to look at the assets, look at the value, look at the condition they're in, just to make sure that the numbers going into the account are a fair representation of the value of the assets. And of course, the importance is, if we don't impair something, we're overstating the value of an asset, which makes it's bad accounting, unethical, and misleading, and it will catch up with you one day, because those assets one day will be sold at a loss, and then there's some explaining to do. So this one is 38, intangible assets. Very woolly. Why? Because they don't physically exist. Copyright, patents, trademark, software, generally only internally bought ones, not internally generated ones, and what we can capitalise in terms of development. So if we're developing something for publication, that's fine, even though we generate internally, if we can produce some costs. How to depreciate? Well, it's not going to be a straight line or anything like that. We've literally got to revalue everyone and think about them carefully at the end of every year. For some businesses, these are very important, and we need to do an impairment test every year on every single one. Getting towards the end now. Income tax is a fairly short one, fairly easy to understand. The treatment of tax liabilities, whether current or deferred. Not deferred, you're paying it later for some reason. Maybe you've been very nice to HMRC and they've let you pay late. But ultimately, in the accounts, corporation tax is a best estimate. Done by professionals, valid, verifiable, set of calculations, but somehow or other, when the buttons are pressed, sometimes it doesn't always quite work out perfectly. So they're often paid in instalments. So you will have paid some of your corporation tax in advance based on the previous year's tax liability. So income statement figures may need to be adjusted at the end of the year. SFP should really show how much is owed at a particular time. There's a watered down version in some exams which just show, they just have to give you the figure, because you can't really work it out without a massive amount of detailed information. Then there's the good old IFRS 16 leases. I must admit I dread teaching this one every year, and yet it's relatively straightforward if you use a good book. Standardising the treatment of leased property, plant and equipment. Why? Because the old IAS 17 allowed items to be treated as off balance sheet. In other words, a lease item, in theory, you don't own, it belongs to somebody else, but in reality it's owned by a finance company. And people abused it. They didn't therefore need to show them in the balance sheet, or in fact they didn't need to show liabilities for like 3 or 4 years time. So it uses the notion of control. So if you have the right to use an asset for 5 years, you treat it as if you are owning it for 5 years and depreciate it over the 5 years, as well as showing how much money you have to show the finance company to pay off the lease. Reality over paperwork. And a good example of an IFRS being a modern version to solve the problems of an old IAS. So last pages of IAS and IFRS. So 3 and 10 to do with mergers and group accounts. Essentially, 3 is the one that explains it all, and then 10 is the sort of explanation of what consolidated accounts should show and how it looks. Bear in mind the variable returns from companies and obviously expected returns, and also things that you will do if you do level 4 AAT, DAFE units, and some high level units where there's intercompany sales. There is another IFRS, used to be examinable 28, and that's basically investment, so where you don't own more than 50% of a company or don't control the company, because you may only own 10%, but if you appoint the whole board or even 2/3 of the board, you control it, therefore it's part of a group without owning 50%. And then one last one, the revenue. A revenue seems a simple concept. It is actually relatively straight, but somebody has to write it down on paper and explain it. Most companies, it's clear. You know, if you're Tesco, your revenue is what people pay through the tills. That's nice and easy. However, other companies, investment companies, their investment comes from different places. Of course, you will get bank interest received for some small companies, interest on reserves and other investments if you've got money invested in other companies, and that's not revenue, that is other income. Likewise, gain on disposal of an asset is other income, nothing to do with customers, and the proceeds of disposal is other income, it's nothing to do with customers. One last page then, just generally speaking to finish off. Other rules and policies, don't forget the conceptual framework. This is very important about the concepts, in other words the accruals, concept, the going concern. And then the qualities, verifiability, consistency, and some ethics as well mentioned in the conceptual framework. You can download the conceptual framework quite easily off the internet. And then this is the one that actually describes the actual statements required. It doesn't give them the names that we're familiar with. It talks about a statement of performance and a statement that explains in rough terms money going in and money going out, the cash flow statement, and also a statement of assets, liabilities and equity. Then, of course, we have the good old Companies Act, which has been around for a very, very long time, constantly updated about what you have to report and the basic description of an entity, as in the limited companies. And then, of course, every year the budget updates a new Finance Act, may affect the liabilities of companies retrospectively sometimes, and therefore you may need to do some adjustment in a set of accounts. And then of course there's lots of HMRC rules. So remember, financial statements are produced for shareholders, so HMRC rules don't affect that. It's the director's job to produce the financial statements, so all directors are responsible for the production of financial statements. If they subcontract a firm of accountants, that's fine. It's still ultimately the director's responsibility. They're produced for shareholders. Other people can look at them. The versions that go off to Companies House still use a lot of UKGAAP terminology, still uses, I've filled in one or putting the numbers in a template for one in the last few days for fixed assets. That went out of date a long time ago. But Companies House still use that terminology. And HMRC, the tax returns, are very, very different. So, I did mention earlier, sole traders partnerships, UKGAP style accounts, but you still are ethical, you still use the conceptual framework, they're still verifiable, they are still ethically created. But having said that, I do know that more accountants are actually just reducing and simplifying the older style accounts and just grouping together the expenses as per the IAS IFRS 18 layout, and that's pretty much a wrap. So good studying, concept plus practical aspects.